Dumela. I will be doing manufacturing and fixed assets, and this is 51 marks. It's supposed to take us 31 minutes to finish it. We need to refer to information relating to Molantwa motors, fighting the war motors, and part A is for fixed assets. Now we've got this calculation space. The first part of this calculation space requires us to calculate additions at cost. Right, let's see what we've got here. So we've got question for manufacturing and fixed assets, 51 marks, 31 minutes. And we have information for part A and B relates to Molanto Motors. Molanto Motors manufactures an affordable gate motor for residential use. Their financial year end is the 29th of February 2024. This translates to the beginning of the year being the 1st of March 2023. And their fixed assets consist of a number of delivery vehicles and manufacturing equipment. Now, for part A, fixed assets, 16 marks, 10 minutes, we've got delivery vehicles. Additional transactions involving delivery vehicles that took place during the year. So, this is what happened between the 1st of March 2023 and the 29th, 2024. Now, A says that traded in an old vehicle on the 1st of March 2023 for 250,000 rand. Now, trading in means we are getting rid of this vehicle for a new one. It's an exchange. Back then, they used to call it barter trade, goods for goods. But here, it's goods for goods. However, the new vehicle may cost more. I need you to understand that this 250,000 that you have been given here does not translate to the cost price of the new vehicle. It is simply the selling price of the old vehicle. We are valuing the old vehicle at the 250,000 rand. That's what we feel like it is worth. That's how much we are selling it for or exchanging it for. Therefore, that 250,000 rand, it is not the cost of the new. It is definitely not the cost of the asset that we're getting rid of. It is what we expect to get for selling this asset. If we were to sell this asset, we expect to get 250,000 rand. So this 250,000 rand becomes the selling price. Then it continues and says, the vehicle originally cost 495,000. Note that that 495,000 is the cost price of this vehicle that we are getting rid of. Okay, and it had an accumulated depreciation on the vehicle at the 1st of March 2023 that amounted to 246,500. Here you were pretty much lucky. They gave you accumulated depreciation of this asset at the beginning of the year, which is 246,500. Okay, good. Let's move to B. The new vehicle was purchased on the 1st of March 2023. That, guys, shouldn't be a surprise because these two vehicles here were traded in. So the new one was traded in, the old one was traded in for a new one. So that was the old one was traded in on the 1st of March 2023, which makes sense that we actually got the new one on the 1st of March 2023 because it's a trade-in exchange. Okay, that's what it is. And then they say to you, delivery vehicles are depreciated on the diminishing balance method. Ladies and gents, this diminishing balance method, it is just telling you which formula to use. Then you have two formulas, well, now you have three methods of depreciation. So this one for diminishing, it is also called the carrying amount or carrying value method. It is also called the book value method. Now, when it comes to the diminishing balance method, to calculate your depreciation, you will simply take your cost price minus the accumulated depreciation of the asset being sold at the beginning of the year. And then you times it by the rate Then you times it by the number of months you used in the current year divided by 12. You use the vehicle in the current year divided by 12. I need you to understand that that cost minus accumulated depreciation, this part of the formula, this one here, is called carrying value. So you're basically just taking your carrying value or the carrying amount, you're multiplying it by the depreciation rate. In this case, it is that 18%. You multiply it by the number of months you've used this asset in the current year. You divide it by the total number of months in a year, which will be 12. That is what it's simply telling you. You have to use this formula. Whether you're calculating depreciation of the new, the old, the sold, you will use that formula. That's what it tells you. It's an umbrella formula we have to use to calculate depreciation when they tell us that we are depreciating our asset on diminishing balance method. Now, depreciation for the year ended 29th of February 2024 was as follows. Note that we do not need to calculate depreciation. They're giving it to us, so you need to celebrate. For the asset that was sold or traded in, depreciation is 22,365. No need to calculate it. Note that they gave us the carrying value of this asset at the beginning of the year. So they did not give us the carrying value of this asset at the date of sale. We still need, actually, they gave us accumulated depreciation at the beginning of the year. They didn't give us the carrying value. However, you can easily calculate it. Now, to calculate the carrying value at the date of sale, you will take carrying value at the beginning of the year minus current year depreciation, which is this 22,365. But it should be easy to calculate carrying value at the beginning of the year. I mean, you've got the cost price, which is 495,000. You've got accumulated depreciation on the 1st of March. 1st of March is the beginning of the year 2023, which amounted to the 246,500. So you just subtract those two to get your carrying amount of carrying value. To emphasize this, guys, carrying value is just cost minus accumulated depreciation. You got that? We good? Gang gang. B says vehicle. The new vehicle, the depreciation on it was 74,250. And then they did not give us the depreciation of the remaining vehicles or the old vehicle. But we were given depreciation of the new vehicle, which is that 74,250. Interesting. I'm going to take this one then. Here they wanted us to calculate additions at cost. And if I were to draw my financial year, I will start on the 1st of March 2023, right? After March, we've got April. Right. Now, we were told when this new vehicle was purchased. I mean, guys, I just highlighted it for you that it was purchased on the 1st of September 2023. It was purchased on the 1st of September, which is round about here, right? I'll make it green because it was just purchased. Okay, we just make it green. And it was purchased round about here, but we don't know what the cost price is, right? It was basically purchased for X amount. Now, if it was purchased on that date, I noticed something here. We were given depreciation on this asset. Now, calculate how many months we used this asset. Because it was on the 1st of September, when I count from that day, after that day. So that after one, I still have September. So it'll be September, October, November, December, January, February. 1, 2, 3, 4, 5, 6. This new vehicle was used for 6 months. I mean, this new vehicle was used for 6 months, and the rate was given to you as 18%. Gang gang. Times this, you use it for 6 months out of 12 months. Someone might say, but why are we using the cost price? It's because here, for a new vehicle, the cost price and the carrying amount are the same because the new vehicle does not have accumulated depreciation in the year it was purchased. We good? Gang gang again. However, I need you to understand that whatever the cost price was there, when I multiply it by 18%, and I multiply it by the rate and I multiply by the number of months it was used, it will give me my depreciation, which was given to me as how much? 74,250. You will take this and equate it to x times 18% times 6 over 12. 18%, when you times it by 6 over 12, it will give you 9% is equals to the 74,250. Now, to solve for x here, I will just say that x is equals to 74,250 divided by 9%. That should give us the cost price of the new vehicle, which is, let's check, 74,250, am I right? Divided by 9 shift percentage, it gives me 825,000. Yay, hooray, we done. That is the cost price of the new vehicle. We good? Fade, fade, gang, gang. Right. The second question wants us to calculate depreciation on the remaining vehicle. Now, by now, you should have how to do this. Okay. You need to separate the cost price. You should be given the cost price of the old vehicles, which is not here. If it's not there, you look at your tangible asset note. It should be there. There we go. Do you see what they gave us there? So we've got the cost price of all vehicles, which is just that 3,465,000. So I repeat that this is the cost price of all vehicles, right? I'm just going to put it here. Okay, why is it doing this now? So according to this, the cost price of the old vehicle is this, right? It was given to us. From this, I'm going to minus. Note that this is of all, right? I'm going to minus of sold. And of sold was given to us this side. Accumulated depreciation of vehicles sold is this value here, which is that 495,000. I'm simply going to take this 495,000 and minus it from the cost price of the other one. which is of all. Now, when you minus these two, you will get the cost of the remaining all old vehicles. Let's see how much it'll be. 3,464,000 minus 495,000. It'll give you 2,969,000. This is 464. 64 is supposed to be 65. 2,970,000. So this is the cost of the remaining. Let's do the same thing with accumulated depreciation. I'm going to take accumulated depreciation of all, this one over here. And the accumulated depreciation of all was given to us as 2,000,000 183,000. I'm going to minus accumulated depreciation of the vehicle that was sold at the beginning of the year. And accumulated depreciation of the vehicle sold at the beginning of the year was also given to us. I brought this to your attention. And there's this value here. You're going to minus it here. And this will give you accumulated depreciation of the remaining. Make sure you put it in brackets. It gives me 1,000,000 936,500. Find your carrying value. It'll be 1,034,000. To calculate depreciation, which value am I going to take? Will I take the 2,970,000 or will I take the 1,034,000? Which value will I take when I calculate my depreciation? Oh, I noticed something here. It's 500. And I don't have 500 in my final answer. There we go. Will I take the 1,033,500 or will I take the 2,970,000 and why? You will definitely take the 1,033,500 multiplied by 18%, multiplied by 12 over 12. This is because we have used this vehicle for 12 months. So how much will be depreciation? It'll be 186,030. There we go. That'll be your depreciation. Well, of the remaining. Now they want us to calculate disposals at carrying value. How do we get disposals at carrying value? At the date of sale, you will take the cost price, which was given to us as 246,000. No, I'm lying. It's 495,000. You will minus accumulated depreciation at the beginning of the year, which was 246,500. And then you minus current year depreciation, which amounts to 22,365. That's how you will get carrying value at the beginning of the year. So what do? You just take your cost price, you minus accumulated dip at beginning of year, then you minus depreciation for the current year. That's how you will get your disposals at carrying value. I know most of you are used to taking cost minus accumulated depreciation, which is made up of accumulated depreciation at the beginning of the year plus current year depreciation, and then you minus it. It's the same principle. These two will give you, when you add them, they will give you accumulated depreciation at the date of sale. Obviously, cost won't change in this scenario. Now, let's calculate it. Let me just make sure that these values are correct. So I've got cost as 495,000. Accumulated depreciation at the beginning of the year is 246,500. Brilliant, right? Now let's put this into our calculator. 495,000 minus 246,500 minus 22,365. It gives you your carrying value at the day of sale, and the carrying value on the day of the sale is 226,135. It will be 226,135. Okay, that's how you get your disposals at carrying value. Now they want us to calculate the cost price on the 29th of February 2024. Now note that to calculate the cost price, everything has to be the cost price here. So it's cost price at beginning of year plus cost price of purchased minus cost price of sold. Cost price at the beginning of the year, I showed it to you, it was 3,465,000. Cost price of the new, we calculated it is 825,000. And cost price of the sold, we just recorded it was 495,000. All of this will give you the cost price at the end of the year. Let's see how much it gives us here. Your minus 495,000. You add this one, add additions. It'll give us 3 million, a million. Okay. Now that will give us 3,795,000, which is the cost at the end of the year. We have pretty much calculated everything. Additions, it was 825,000. Disposals at carrying value, it is 226,135. Is it 26,125? Let me make sure. Yeah. And you put it in brackets. Current year depreciation, you just add all your depreciations from this side, which will be the 22,365. You add it with 74,250, and then you add it with current year depreciation of the old, which is 186,000. So I'm going to add here 186,030. So this is your depreciation for the year, which is the sold, the new, and the old. Sold, new, and old. Snow. Sold, new, and old. Snow. Sold, old, sold, new, and old. Snow. It's a snow, right? No. And that'll be your depreciation for the year. And it gave us how much here? 282,000. 282,645. I just need to make sure that everything is partial here. Can I recalculate this? 1,33500. 0,33500. 12.18. Okay, so that is correct. That will give me my depreciation for the year. Cost at the end of the year, we've just calculated it. We calculated this somewhere. It's 3,795,000. There you go. There you go, guys. Let's go. Right. We're gonna be doing part B in the next video. Please be on the lookout for the next video, which will be posted shortly. Thank you for your continued support. See you at our offices when you guys come for lessons. Please check details for more information. Awesome.